Hi everyone, today I'm going to be talking about Boohoo, a UK fast fashion company that's a pretty big name, major competitor to ASOS, listed on the FTSE AIM, pretty beaten up this year, down 65%ish on the year. And I'm going to be talking about why I'm buying Boohoo recently. I finally took the plunge, started buying around £1.03, and we continue to average in over the course of the next few weeks and months. First things first, I've always liked Boohoo's vision and strategy. They have a strong vision, they want to become a global fashion e-commerce leader. I love the ambition and the reasonably good execution so far, at least in the UK. The company has seen excellent revenue growth. They've made some reasonably good acquisitions of some popular brands and, as far as I can see, have integrated them really well into their core website. This month it announced it was moving into 5 new markets: Japan, Korea, Singapore, Hong Kong and Taiwan. Developed countries in Asia trying to attack these huge markets that have really big potential. Then it's really good to see if they can do it sustainably and without taking on too much debt. I think this could be a really good play for them. I'm not sure how much they're so focused on brands. I'm not sure how much brand equity they carry into Asia, but only time will tell. So looking at the brands, particularly in the UK, some of these are quite big names, particularly Pretty Little Thing. They recently acquired Debenhams for 55 million. They have a strategy of taking on struggling known high street brands and integrating them into the online store, along with their up-and-coming brands like Nasty Gal, which they also acquired. And acquisitions like this show that Boohoo are trying to widen the primary demographic of 18 to 24 that they see with Miss Pap, Nasty Gal and Pretty Little Thing. They're trying to widen that with acquisitions of Debenhams for 55 million, Burton Wallace and Dorothy Perkins from Arcadia Group for 25.2 million. Again, both when these are collapsing, so for relatively they can carry some brand equity for pennies on the pound. Pretty Little Thing they actually acquired for just £3.3 million for two-thirds of the business. The original shareholders retain the rest. Really strong history of acquisitions, really good integration, and just an eye for the right opportunity for different acquisitions, in my opinion. So our primary attraction to Boohoo is really strong financial performance at a relatively cheap price, really strong sales growth, above 40% for the last 5 years, trending down slightly, but of course as the company gets bigger. It's a relatively mature company now, so it's having to seek growth from elsewhere, but these are pretty consistent margins with really strong sales growth. So the profits have been scaling really nicely. These type of margins are not so impressive for the wider business world, but for this industry I think this is really strong. Boohoo spends a lot of its marketing spend on influencer brand deals and internet advertising and offers, so this is relatively capital intensive but has really good conversion rates. Good cash position to build out infrastructure and make acquisitions and push that growth forward, which I really like to see. And overall I think this is a really cheap business right now, 1.5 billion market cap ish. Really cheap business with a rock solid balance sheet and consistently strong growth. All the signs are looking good. So why is it so cheap at the minute? So Boohoo shares have been on the downtrend for about just over a year now. Took a big hit recently when it announced that its sales growth is going to be around 12 to 14%, a big hit compared to its previous guidance of 20 to 25%, and that its adjusted EBITDA margin is going to be 6 to 7% compared to 9 up to 9.5%, and they're going to have to increase some costs based on basically primarily due to the warehouse restructuring, brand restructuring. The way I see this is margins are slightly depressed and growth is slightly depressed in the short term due to elevated returns, which is a seasonal problem. In the UK, there's been some new restrictions on movement and maybe a potential lockdown. A lot of Christmas parties and things like that have been cancelled, so they're basically blaming some of the loss in revenue due to dress returns and things like that, which to me is an absolute one-off. This is not going to happen every year, although it did happen last year as well, but eventually these restrictions are going to ease, and this is a kind of one-off. This is the type of thing that happens in this industry. It's not something to worry about in my opinion. And the restrictions around potential lockdown, that's going to cause supply chain crunch. That's part of the reason why Boohoo's share price is depressed anyway, is there's a inflation is hurting the freight costs. These, in my opinion, are transitory issues that are not going to last forever. So I'm quite okay with this. So the catalyst to Boohoo's initial share price decline last year was some stories coming about modern slavery in Boohoo suppliers, sub-minimum wage pay and awful conditions at some of the suppliers in Leicester. The business is now part of the Leicester and Garment Workers' Trust to try and work towards improving conditions and remedying the damage caused. I think it's by no means complete, but I believe Boohoo is making a concerted effort to improve on this front. I think this is a genuine concerted effort. I think they are genuinely remorseful about these, and they did acknowledge an independent inquiry to prove that it was wrongdoing done. I would not own a business that I believe was supporting these practices, and I don't believe Boohoo is supporting these practices. I think they're making a concerted effort to fix this, and I'm quite happy with what Boohoo is doing right now. I think they could be doing more, yes, but they're working on it, and that's all I can ask. So I'm basically buying Boohoo now because every man in his price. I was not particularly a fan of Boohoo at £3 numbers, and I wasn't a fan at the £2 numbers either. But now it's sitting at £1, and it has a forward PE of around 12. Earnings are depressed because of supply chain challenges and lockdown restrictions, which are both short term in my opinion. The market is very short term and has really lashed out with Boohoo for these problems. Same with ASOS. ASOS having the same problems, but current PE's 24, forward PE's around 12 or 13. This just seems really, really cheap to me. Right at its 52-week lows. I think this could easily be a 2 to 3 times return and get back to the £3 range in a year or two. This just seems to me like easy money at these sort of prices. Boohoo is not going away. It's growing at, even in a really challenging year. It's going to grow 15%. Next year they predict growing 20 to 25%. Hopefully they can get up to the closest to the 40% numbers. A £1.4 billion market cap. I think this could be a significantly bigger company in 5-10 years. I don't think 10x in the next 10-12 years is completely unrealistic. So I think this is a really, really attractive time to buy into a growing business. And again, at price to earnings of 12 forward, this just shows a really high margin of safety. I think, like I said, every man in his price, and I'm happy to buy Boohoo at these sort of prices. I think this is just easy money. But again, this is not personalised financial advice. You should do your own research. This is just my opinion. So thanks, and I'd appreciate it if you could like and subscribe.